Hello, and welcome to the July 2022 Economic and Market Update presented by Commonwealth Financial Network. My name is Brad McMillan, and I'm Commonwealth's Chief Investment Officer. June was another terrible month for financial markets. Growing worries about a recession, coupled with continued high inflation, kept investors on the run by raising concerns about future earnings, on top of the existing worries about interest rates. Stock markets, both here in the U.S. and abroad, were down substantially for the month, with developed international markets getting hit the hardest. The terrible month also capped off a terrible quarter, with stock markets around the world down between 10 and 30%, and with even fixed income down sharply. According to the Wall Street Journal, this is the worst first half of the year since 1970. The underlying reason, of course, has been the Federal Reserve. With inflation persistently high, the Fed has raised interest rates throughout the past 6 months and has signaled it plans to continue to do so. Markets have responded by repricing both bonds and stocks, which was the first phase of the downturn. More recently, though, risks of a recession have risen, driven by those higher rates. With the Fed apparently committed to getting inflation under control, even at the cost of a recession, fears about the economy have risen, raising concerns about lower corporate earnings and knocking markets down even further. Everything that could go wrong for markets pretty much did in the first half of the year. While it's been a perfect storm for markets so far, though, June showed signs that the damage may be peaking. Inflation, while still far too high, showed signs of easing as supply chains continued to improve. The international situation, despite ongoing COVID lockdowns in China and the war in Ukraine, appears to have stabilized. And with fears of a recession rising, even as inflation starts to moderate, longer-term interest rates have showed signs of pulling back. So while real risks remain, at least they've started to moderate and even improve a bit. Another positive factor looking forward is that despite the risks and the headlines, the economic news is still pretty good. Companies are still hiring, supporting spending growth, and business investment remains healthy. Looking forward, of course, the question is whether that'll continue, and there are real signs of softening, especially in consumer confidence. Although it remains outside the risk zone, it continues to trend down, and that could be a problem. But here, too, the risks are starting to moderate. As inflation and interest rates stabilize, so will confidence in the economy. On the whole, while growth is slowing, we see little or no direct fundamental damage in the data yet. In other words, while real risks remain, as far as the economy is concerned, we are still growing. And that solid economic performance, combined with the moderation of the inflation risks and long-term interest rate increases, should provide support for markets going forward. Historically, future returns after a pullback like the one we've seen this year have been positive, often significantly so. So with valuations now close to fair levels, we have less risk on that front. And while earnings risks may be real as the economy improves, so will those expectations. It's been a painful start to the year, but as painful as this is, it has set the stage for future growth. And we're now well into that process. Now, that's not to say we're done with turbulence. Interest rates could rise further. COVID could surge again. The Ukraine war could expand, and when and if those bad things happen, we will see more market volatility. But despite the headlines, most of the risks appear to be moderating. And as they moderate, over time, the fundamentals will improve. And that's what drives both the economy and the markets. And that's the bottom line here. Lots of bad things have happened, but the bad news is starting to get less bad, and even to improve. And as markets start to reflect that, we should see more stability. The risks are real, but despite those risks, the fundamentals remain sound. And that provides a good foundation going forward. That's it for this update. Thanks for watching. Join me in August for the next one, but until then, be sure to check my daily blog, The Independent Market Observer, for more timely comments. Stay safe, stay sane, and stay healthy. We are getting through this together.